Today on InvestTalk, we talk about why Costco has been so strong, answer questions about tickers REZ, WMS, and SSNC, and then ended the day talking about China.
This is InvestTalk, independent thinking, shared success.
Now let's shift back and talk about our main focus point today, which is a company whose stock has been doing particularly well, Costco. And more specifically, what is the surprising business that is driving Costco's growth in 2024? Now, we want to ask this because Costco is well positioned for its ongoing success, and a lot of that is because it started to chip away at some of the hegemony of e-commerce. So let's take a look at Costco and why its stock remains resilient despite a slight revenue miss last quarter. While Costco's total revenue increased by just 1% year over year, falling short of expectations, the stock is still up 34% year to date. Investors continue to have strong confidence in Costco thanks to its reliable growth and its long-term potential. A key driver of Costco's future success is its growing e-commerce segment, which has been a bright spot recently. E-commerce sales grew by 18.9% in the most recent quarter, marking 3 consecutive quarters of double-digit growth. This digital shift is gaining traction as more members turn to Costco's online offerings for larger items like appliances and furniture, and those items aren't really grocery items, and so they can take a little bit longer to be delivered. Costco's ability to handle its own logistics has really always been a major factor, not only to the success of the e-commerce business, but to the business as a whole, right? We talk about, and I joke about all the rotisserie chickens that they sell all the time. But one of the reasons why they've been able to do that and manufacture them is because they do it themselves. They are so very good at logistics. The company's delivery business moved over 4.5 million products last year, a 30% increase. While managing logistics for bulkier items presents some cost challenges, Costco is finding ways to make the online segments more profitable. And so looking ahead, I would expect Costco's e-commerce growth to play a larger role in its overall revenue, especially as interest rates decline and consumer spending on those more high-ticket items starts to pick up again. Its robust logistics capabilities, loyal membership base, Costco is well positioned for continued growth, even in the evolving retail landscape. And so the bottom line for me really goes beyond just a lesson about this individual company. And the bottom line is that there's a lot of ground to be gained in e-commerce, not from just Costco, but other companies as well. And many other companies are seeking to challenge the power that retailers like Amazon have held for quite some time. And so when you look at a company that is frankly a very big ship like Costco is, and you see one of the world's largest retailers signaling, not just to shareholders, but to the market broadly, that kind of growth is possible and that there could be a lot more growth on the horizon, I think you should then look elsewhere within the sector, look elsewhere within the industry, and see where maybe particular niche areas of an e-commerce business that is held by Amazon, that is held by Walmart, may be vulnerable to competitors heading into the end of the year when people are buying a lot of things for Christmas and for the holidays and heading into next year as well. Let's talk about the market today before we go any further. U.S. stocks finished higher in overall uneventful trading from a macro perspective. S&P notched a fresh closing high, while the Nasdaq now less than 1% below its July 10th all-time high. Big tech was mostly higher with NVIDIA, the group's standout. Other outperformers included the broader semi space, home builders, building products, banks, and insurers. Relative underperformers, and I do say relative because most of the market was green today. Relative underperformers included energy, chemicals, grocers, tobacco, retail, machinery. Treasuries were closed for the Columbus Day holiday, so not much to talk about there. Gold finished down 40 basis points. Crude oil ended down 2.3% near the lows of the day. It was a very quiet start to the week, given that the bond market was on holiday. There was a lack of earnings reports and really just a waiting game ahead of key macro data coming later in the week. Valuations, election uncertainty, repricing of Fed easing expectations, bond yield backup, and elevated VIX all really loom amidst an otherwise green day. Just a bit of Fed speak today. Minneapolis's Kashkari said economy in final stages of getting inflation back to 2%. Governor Waller discussed several possible scenarios, including a pause if inflation returns. Nothing on the U.S. economic calendar really today, Thursday, the big day for data with retail sales initial claims and industrial production, as well as the Philly Fed manufacturing and housing market index on the calendar. Headline retail sales seen up 30 basis points month over month in September, following a 10 basis point gain in August, while core retail sales expected to increase 40 basis points after a 30 basis point gain in the prior month. Following those items, housing starts will be on Friday.
I have about a 10% position in an intermediate term bond funds. I'm retired, and I'm thinking of taking half of this and putting it into a residential REIT, specifically REZ. I'd like to stay away from commercial and retail REITs. What do you think? Is it too late to the party, or go ahead with this move? Thank you. I'll listen for the answer.
Great. Well, if you are in retirement, then it is likely that you need income. So it makes sense to have a higher allocation to bonds or income producing vehicles. In this case, you're looking at REZ, the iShares Residential and Multisector Real Estate ETF. Here's the problem. This is the definition of judging a book by its cover. This actually stopped being a pure residential ETF in September of 2022. So you're saying that you do not want exposure to commercial REITs. Well, you're going to get exposure to self-storage REITs. You're going to get exposure to healthcare REITs. You're going to get exposure to apartments, manufactured homes, single family homes. And so that's why it's important to dig deeper than what at first glance seems to be what you are looking for. And so let's take a look at this fund specifically for everybody else. 85% of it in large caps, 11% in mid caps. About 40 names is what it holds. Top 10, about 66% of it, all within the United States, all REITs for the most part. And in terms of what it holds in terms of its valuation, it's pretty middle of the road. It plays a slightly higher dividend yield than the benchmark. It's done pretty well over the past 3 months, year to date, up 18%. Some REITs are doing well. Why? Well, REITs do well when either rates are falling or the path of interest rates is certain, because it's a very heavily debt-focused business. So is this a fine residential and commercial multi-sector real estate ETF? Yes. But for your purposes, if you are just looking for residential REIT exposure, this is not the one for you. Thanks for the call. Now, I hope you understand by now that you don't just have to listen to us, you can also watch us. And in order to do that, you head over to YouTube and type in InvestTalk with 2 T's. Make sure there's 2 T's, because 1 T, and that is not our channel. And while you're over there watching our videos, if you have a question and you don't feel like calling in, well, you can go over to the comment section and just type it out. And we will get to those as soon as we possibly can. So let's get to one now from Cam, who has a question about WMS. It says, "Hey, Luke and Justin, I've been enjoying the YouTube videos. I was hoping you could give your thoughts on the company Advanced Drainage Systems, stock ticker WMS. Would you be concerned with rising oil prices, given a large portion of their products are made using petroleum products?" Let's take a look at this name, and that is Advanced Drainage Systems. And so Advanced Drainage Systems designs, manufactures, and markets polyethylene and polyurethane pipes, plastic products, all sorts of septic tanks, all sorts of products that do in fact require the use of oil in terms of the production of those things. And so let's take a look at the balance sheet here. So it's about a $12 billion market cap company, about $1.3 billion in debt. They have raised debt a little bit since 2020, but not much in terms of being alarmed. Their cash flow has been improving. Their profitability has been improving. They pay a 42 basis point dividend. That's their dividend yield. And their dividend per share has increased every year pretty consistently, from 32 cents per share up to about 64 cents per share this year. That's doubling in just about 5 years. In terms of revenue growth, very solid, about 15% year over year going back to 2019. Though it is important to note that the bulk of their revenue peaked out in March of 23. Their fiscal year ends in March. So for them, the fiscal year 24 is already over. They saw revenue fall. It's projected to rise again heading into 2025. Now, one thing I would say here is, yes, given that oil is an input to the production of their products, there is the chance that if oil prices continue to rise, then you could see some adverse effects on their net income. Now, what you haven't seen is really margins compress all that much. You see back in 2019, about 10% margin. Even when they had peak revenue back in 23, it was 23% net margin, about to be 26. Oh, I'm sorry, I was looking at the wrong line. 16% net margin, projected to be about 17%. So you do see this growth in margins, even as revenue has fallen. And so with the price of oil being a little bit more stubborn upward than some people expected because of rising tensions, the question is, well, what effect will that have on the bottom line? I still think that in spite of geopolitical tensions, there's a lot that is suppressing this rise in oil prices and really has a tighter ceiling than I think most people realize. So I wouldn't be too concerned about the price of oil spiking and affecting the bottom line of this company. I would say that given it's trading below its 5-year averages in terms of its price to book value, certainly forward-looking price to earnings, this could be a potential buy spot here. But again, one concern I have is over the past 2 years, you've really seen growth fall off. Really going back to 2022, there hasn't been a lot of growth there, the bulk of which came really out of the pandemic. And so as growth has started to fall off a little bit, I think what you've seen is some of the momentum from this name fall off as well. Overall, I think it's probably a pretty solid business. They have a very strong balance sheet. Even though it's trading below its 5-year averages, I don't think it looks that cheap to me right now. I'd probably keep it on my watch list, see heading into the new year how quarterly revenue picks up. Thanks for watching. Let's swing back to the InvestTalk voice bank for a question that came in earlier to 888-99-CHART.
Hey, you guys, this is Art from Tucson calling in today about SS&C Technologies, HL. That's ticker SSNC. I have about a half position in this company, and I'm thinking about adding to it, buying into the momentum. It's up quite a bit, and I'm wondering if I should add to it at this price, or what you think about the company and what you think about its momentum here, and if you would expect it to continue to go up. Anyway, I'll listen on the podcast. Thanks for all you do for us. Bye.
SS&C Technologies is a IT services and software company. Their clients are primarily financial services firms and the healthcare industry. To make a long story short, we do like this name. We hold this name for our clients. It is up 47% on the 52-week, up 23% this year. That's on the back of some pretty strong revenue growth over the past 5 years. As what you've seen is a situation where a lot of financial services firms and fund managers have started to outsource a lot of their administrative work. And so that has been a pretty solid strategy for SS&C to pick up some pretty sticky business. Its free cash flow looks pretty solid, though it has kind of flatlined over the past couple of years after really peaking out in 2020 in terms of growth. Another thing we like, they are buying back shares from 2020. They had 255 million. Now they got 245 million shares outstanding. It's a, It's a pretty large company, 18 billion market cap with about 6.7 billion in debt. So certainly not too much debt there. They pay a 1.33% dividend yield, and that dividend has grown more than tripling since 2018. As I said, we like this name. We hold this name for our clients. It's done particularly well over the past 52 weeks. And honestly, we still think it has some room to run because it's trading at a pretty fair valuation, only 13 times forward-looking earnings, only 3 times book value. I think it benefits from, again, having that sticky core business. And a lot of other firms, specifically within financial services in the healthcare space, really wanting to outsource the things that they're not necessarily as good at. So we hold it for clients, and for the foreseeable future, we will continue to do so. Looks like we have a live call. Let's go to Sammy in San Francisco, who has a question about SIRI, and me even saying that name activated my phone. How can I help you?
Thanks, Luke, for taking my call. I have a question. If you think it's a good time for someone to get into the stock, Sirius XM.
Yeah, of course. Well, let's take a look at ticker SIRI, which is Sirius XM Radio. It is a broadcasting company. And so I have had some differing opinions about broadcasting companies for quite some time, because I just think, generally speaking, the way that people receive media has fundamentally changed. But we'll put that on hold while we take a look at this company, and we're waiting for some things to load here. And so it is an $8.4 billion market cap company. It's got quite a bit of debt, $9.3 billion in debt. It pays a solid dividend yield, but that's because it's been falling off of a cliff this year, down 50%. And so that's pushed that dividend yield up to 4%. 4% dividend yield. And what we know about dividends is, well, they're not set in stone. They can certainly be cut. And in times of distress, you see them cut all the time. Now, the revenue has fallen from the peak in 2022, a time when, well, a lot of people, 2021, 2022, had more disposable income to spend, were trying to entertain themselves in a way that wasn't interacting with other human beings. And so, well, SiriusXM did particularly well in those times, but revenue has since fallen as well. And so looking at this company, there's about 5% short interest out there. And I think the reason why is because, well, growth has slowed and they have a lot of debt they need to service. Cash flow has kind of flatlined a little bit. Profitability has fallen as well. And so when the market is showing you a company falling off 50% year to date, and you still see some short sellers out there, even though they're up about 8% today, well, a lot of that is because of that squeeze, right? You have a decent amount of short sellers out there. It squeezes that price up a little bit when there's some demand and people have to cover. But overall, I think the things that are dragging this business down and have been dragging them down for really over a year now still exist within the context of why it's performing poorly. So for now, I would stay away from Sirius, but thanks for the call. Let's go to that live call. George from Washington State, thank you for waiting. How can I help you today?
Hi. Thank you for picking up my call. I'm considering to do a little diversifications in my portfolio and expose myself to the biotech stock. And I'm looking between Roche and Gilead, and I just kind of would like to get your opinion.
Okay. Sure. Let's take a look at, I can take a look at one of those names. We'll take a look at Gilead, ticker GILD. And as you mentioned, it is a biotech stock. Excuse me, try not to sneeze here. And it is a fairly large company, of course, $108 billion. Its dividend yield is about 3.6%, pretty big for this area of the industry. And the dividend's been pretty consistent over the past 5 years, ranging from about 3.5% to 4%. Sorry. And in fact, that dividend has actually grown from $2.28 a share to $3.08 per share. Now, a lot of that may be due to the fact that they are buying back shares from about 1.2 billion in shares outstanding to 1.26 to 1.245 billion shares outstanding. One thing that strikes me about Gilead, and I think you've seen with a lot of biotech companies, is that as rates went up, business became more expensive. And that's because they are very research intensive businesses. You see cash flow years fallen off since 2022. Profitability has fallen off as well since, 2022. And relative strength, it's started to kind of close the gap a little bit with the S&P 500, but it's still not exactly there. Now, you want to diversify your portfolio. I think that's always a good idea. And I like the fact that you're looking at biotech companies that are established companies and not what a lot of people look at in terms of biotech companies. And those are ones that don't make any money at all. In this instance, they made $4.5 a share in 2023. It's supposed to dip to $3.78, though. Next year, projection makes $7.25. I think overall here, one thing to note about Gilead is it's trading in kind of expensive territory for where it typically trades. Price to book about 6 times, price to sales about 4 times. I think it's a solid company. Financially, its balance sheet looks fine. It's only got $23 billion in debt. They've actually paid down about $2 billion, really 4, 6, 7, $8 billion since 2020. So that's something that I like as well. I think it's probably fairly priced to a little bit overbought right now, a little bit expensive. But I would encourage you to continue looking at biotech companies that are, like the ones that you mentioned, established and actually making money and bringing in revenue, and not just revenue, but turning a profit. Thanks for the call. Now, before we get to another talking point, here comes another question from our InvestTalk YouTube channel. This one on ticker BAX. It says, "Hey, Luke and Justin, a while back you had a question about Baxter symbol BAX. Wondering what you think of the company now. Let's pull up Baxter. And so Baxter, let's take a look. Sorry, it's taking a second to pull up here. Sometimes we are at the mercy of the internet. It is a healthcare products company, focuses on acute and chronic dialysis therapies. It is a $18 billion market cap company, has a ton of debt, about $13 billion in debt. It did not make money in 2022. It did not make money in 2023, though it does have a history of making money going back before the pandemic. What's striking to me, though, is that cash flow is falling off and has been falling off and on a downward trend since, well, before 2020. Profitability, again, was negative, though it's set to be positive this year. And revenue has not hit the peak, at least as of 2023, the end of their fiscal quarter in December. It was a drop off from 2022. Now it's projected to be higher. Again, this is on nominal terms, though, not on real terms. And overall, I think that one issue that I have here is generally that growth just has been relatively non-existent for quite some time. And even with that, it's trading at a price to book about 2.4, well below its 5-year average. Its price to earnings is about 12 times, well below its 5-year average as well. And so the lack of growth, coupled with the fact that there's a fair bit of debt here and cash flow has been falling pretty steadily, and not just from 2022, but actually beyond, back towards about 2019, 2018 is when it started to be in a downward trend. I think I would pass on Baxter for now. Thanks for watching. Now, investors have, I would say, been repeatedly caught off guard by the Federal Reserve. After several instances of the market predicting a dovish pivot from the Fed, policymakers finally cut interest rates significantly, only for bond yields to rise again and investors to reassess their expectation for future rate cuts. So why the confusion? And I would say the answer lies in the Fed's data dependency, a policy approach where decisions are based on incoming economic data, particularly around inflation and employment. This method, however, has kind of been problematic as the data has been highly volatile and at times unreliable. Recent economic reports have oscillated between weakness and weakness and strength, creating a wave of false expectations. What do I mean by this? Well, weaker jobs data earlier in the year led the Fed to implement a 0.5 percentage point cut, far more aggressive than many people thought heading into the meeting. But then what happened the next month? Well, it had one of the strongest job reports of the year. And so it reversed the narrative. Now, with economic growth forecast climbing above 3% for the third quarter, there's less of an immediate case for further aggressive rate cuts. And you've seen rates going back up on the longer end of the curve as well. The issue with the Fed's approach is not that they look at data, right? I'm not saying that they shouldn't be looking at data. But I think given that they've shifted their mandate from, well, worrying about inflation towards worrying about overall economic health and worrying about the labor market, they're now focusing too heavily on the most recent data to be released, and that overlooks the lagging effects of interest rate changes on the broader economy. Monetary policy can take months to influence inflation and employment. It can take way longer than from month-to-month reports. And so by reacting quickly to short-term economic fluctuations, the Fed risks adding unnecessary volatility to the bond market. Investors continuously are adjusting their expectations based on these latest reports. Now, while the Fed's data-dependent approach made sense, like I said, during periods of the high inflation when interest rates were stuck near zero, today's environment is different. Inflation, while still above target, is no longer spiraling. And the labor market is stable, but not overheated. In this context, it may make more sense for the Fed to step back from the short-term data and focus more on the broader economic picture, which makes the challenge now for both the Fed and investors trying to strike a balance between reacting to the immediate economic signals and trying to plan for that longer-term stability. Let's keep things moving and answer another question from our voice bank.
Hi, this is Greta from Palm Desert. First of all, thank you so much for your show. Question about investing in industrials. So right now, outside of my IRA and my 401k, Mostly my investments are in tech and energy, and you all had mentioned that there may be a growing momentum in terms of industrials. And if I am looking to just make some small investments in industrials, where would be a good place to start? Thanks so much. Keep doing what you do.
So I think the core of the question is great. I think that you should not be highly concentrated in just a couple sectors. Why? Because it's difficult to predict where the economy will go. I've mentioned this before. Equity performance is 60 to 70% what the rest of the market does. It's then another majority of what's left, overwhelming majority of what's left, what the sector's doing, and then a tiny little bit on stock selection. And so you can't really predict in the short term, in the medium term, you can't really predict what sectors are going to do well. And so the largest risk you actually have is your relative risk, right? That markets will outperform broadly, and you won't keep up, and your relative wealth relative to the overall market will decrease. And so that is why diversification is so essential, because it deals with that relative piece. And it also helps to remove your idiosyncratic risk. Now, in terms of looking for names, I think that the fact that you were saying you want to make some small investments and you have no investments in any other sectors other than energy and tech, I think looking for those low-cost industrial ETFs that give you broad exposure to the industry, that give you broad exposure to different sectors within industrials, is beneficial for you. It's close to impossible to keep up with researching all of these companies. And so ETFs can be an excellent way for you to get exposure. Now, there are some downsides. There's some downsides to owning ETFs, the fees that you're paying, the fact that you don't own the individual underlying asset. You can't benefit from the tax loss harvesting. And we can get into all that another time. But I think for your purposes, a great thing to do would be to look at some low-cost ETFs that give you broad exposure to the industrial space. Looks like we have a live call. Let's go to Sid in North Carolina, who has a question about UPST. Do you own it or are you looking to buy it?
I do have this in my portfolio, approximately 2% of my portfolio, and I do have a good profit due to late run. It's almost double in last 5-6 months, right? So I think according to the guidance that you and Justin teach us, I should be at least start trimming, but not sure whether this stock is still having any more fuel to go up, considering the more rate cuts and so forth. So I just wanted to check your opinion. Thanks so much for your time, Luke.
Yeah, thanks for calling in. And I think I agree with you. When you have this kind of profit, it's always good to trim. Nobody goes broke taking profit. And there are other opportunities in the market that you can capitalize on. Now, Upstart Holdings is a lending platform. One of the my memories of Upstart Holdings is when there was somebody who went on CNBC and started talking about the company, how they thought it would do really well. And then the host asked them, well, what does it do? And the person on the interview pretended like they couldn't hear him, said they had to go. The point being that you shouldn't always listen to these people who are pitching you stocks on CNBC, right? We're not pitching you anything here. We're just trying to give our advice as you call in. And so with Upstart, I think one of the things that strikes me the most is the best rating from any ratings agency. And certainly ratings agencies aren't the be all end all of companies, but I have not found, and I've been looking at Upstart, ratings that are generally better than neutral, right? You have a consensus underweight rating right here from these 16 brokers. And you've had a huge run up. It's up 15% today. And so overall, I would probably be looking to get out of this name. You're up 100% on a week. On the 52 week, on the 1 year trailing time period. And so at bare minimum, I think you should be trimming here. But frankly, I think that you take your wins in a situation with a company that is not really fundamentally sound, and move on from it. Thanks for the call. So this is a topic that has been, I would say, brought up a lot recently. And that's because investors often rely on saying that nothing changes sentiment like price, which reflects how a stock market surge can drive speculators to find reasons to believe that further price increases are inevitable. Enter China. On the 13th of last month, the CSI index, which tracks the largest stocks in Shanghai and Shenzhen, reached its lowest levels in 5 years. Since then, the index has been highly volatile, rising by as much as 35% before subsequently falling almost 10%. Now, the fluctuations are tied to the shifting expectations for stimulus from China's central bank and its government. Investors are hoping that this signifies a turnaround in the Chinese market after 3 pretty difficult years. And what happened in those years? Well, Chinese stocks have been hit by property crisis. They've been hit by government crackdowns on parts of the private sector, worsening relations between China, the United States, China and Europe, trade wars. Through all this, given what has happened recently, given an supposed desire to stimulate parts of the economy, JP Morgan's initial assessment of the Chinese market referred to a temporary period of political uncertainty rather than a permanent situation. This year, analysts have become more optimistic, especially regarding Chinese tech firms. Despite the challenges, some investors are seizing the opportunity. In fact, Chinese equity funds say they saw record inflows in early October, with nearly $40 billion pouring in from both domestic and international investors. Furthermore, the technical barriers to investing in China have eased, and recent regulatory changes have made it easier for investors to hedge currency risk. But despite these improvements, the key question remains: is investing in Chinese stocks a good idea for the long term? For many, the answer is still no. Although China's economy has grown rapidly, this has not translated into strong stock market performance. CSI 300 index has gained less than 25% over the past 15 years. All the while, China's nominal GDP has quadrupled. The deeper issues include poor corporate governance, the dominance of state-owned enterprises, and the government's tendency to unexpectedly change policies in ways that can severely damage investor value. While there have been recent signs of government support for the private sector, it's difficult to trust that no further disruptive campaigns will occur. And so although China is becoming more accessible, the risks still remain significant for most investors. Honestly, Chinese stocks are not a worthwhile investment.
Hey guys, love the show. I was just calling to get your opinion on Hingham Institution for Savings. That's ticker HIFS. That's a regional bank, and I know this is one of the best run regional banks in the country. Very solid, very risk averse, and all their deposits are 100% insured. So I was wondering if I could get your take on it. Thank you very much, guys. Bye.
So Hingham Institution for Savings, ticker HIFS, is a regional bank that operates out of Massachusetts. It is very, very small, about $548 million market cap. And the thing that's striking me the most is, well, cash flow is not doing too hot, falling from 60 million down to 20 million in the past 3 years. Their net interest income has fallen about 6% on an annualized basis. Their loan loss provisions down about 2.5%, which is a good thing. And so as their interest income has grown by about 13%, their interest expenses have grown by about 34%. That's not something we like to see. Now, their dividends kind of all over the place. Maybe they have some sort of program where dividends are more tied to profits of the bank. I'm not sure. But dividends were 192, then 218, 247, up to 303, then down to 252 in 2023 on a dividend per share basis. That's up a lot. A lot of banks are up a lot. It's up 46% on the 52 week. And I think there's less stress than I had about a year ago, right? Coming out of the regional banking crisis, but I still don't particularly like regional banks, especially ones that are this small. And the reason why is highly concentrated deposit bases. I know it's all insured, if it is all insured, as you say, but the high concentration of deposit bases means that if a particular group defaults on loans, right? This is concentrated in Massachusetts. If a particular group withdrawals, it messes with the assets of this bank in a way that is asymmetric to how large banks operate. And so because of that, even if it's one of the more well-run ones, I just generally think there are better opportunities out there than investing in regional banks. Thanks for the call. Looks like we have time for one more, so let's squeeze in another caller question now.
I have a question regarding Sabra Healthcare. Actually, it's a REIT. The symbol is SBRA. Wanted to see what your overall opinion is and what would be a good entry point and what you think the outlook is for the company as well. Thanks for your show, and I'll be listening for the answer there. Thanks again. Bye.
Sure. So let's take a look at Sabra Healthcare REIT, or Sabra. I'm not sure how you pronounce it, but either way, no matter how you pronounce it, the ticker is SBRA. It acquires, finances, and owns real estate properties that are primarily serving healthcare purposes. It's up 27%. Again, we have talked about how REITs have done pretty well as rates have started to fall, though. Let's keep in mind that on an industry basis, it's actually outperforming its industry by 20%, and it's beat the industry every year over the past 3 years. Now, the revenue is stable, I would say. It's about as stable as it can be. 5-year annualized growth rate around 90 basis points. Its cash flow from operations, its free cash flow has fallen from $358 million down to $301 million. I think one of the benefits here is their debt to equity ratio is pretty solid relative to their peers, though the return on equity is kind of almost gone, non-existent. I don't know. I think we've talked about REITs before, and we talk about REITs all the time. And for me, I generally like REITs that have sticky asset bases, storage REITs, right? Gambling REITs. There are some gambling REITs we own for our clients and storage REITs that we own for our clients that have done particularly well. Why? Because they don't tend to suffer the same cyclicality as other types of businesses. Healthcare is more uncertain in terms of the REIT space. So even though the debt to equity looks pretty solid relative to its peers, even though revenue growth is probably higher than average for the healthcare real estate sector over the past 3 years, really 4 years, I still think there are better REIT opportunities elsewhere. Thanks for the call. This is InvestTalk, and I thank you for joining us for another program. You can get our podcasts at iTunes, Google Play, and Spotify. Please be sure to rate and review us on iTunes. Remember, we can help you better understand your portfolio's dynamic and calculate your investor risk number. Just go to investtalk.com and click the portfolio review number. This is a free and confidential service. Also, head over to our YouTube channel. Check out our YouTube videos. That's InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night.